Hey everyone, my name is Nick Saylor of Saylor Business Solutions and the VMG Real Estate Tax Group. Today I am bringing you a video of a very explanation of how tax works. It's an explain it to me like I'm a third grader type of video because tax is confusing. People do not understand how it works, and if you are going to have tax strategy or even understand your personal finances, you need to understand tax. So I'm not going to have a bunch of graphics on the screen and me talking the whole time. I'm going to share my screen kind of like lecture style. So we will get into it right now. Okay, here we are in Excel. So you can see my screen. You've heard of tax brackets before. Everyone talks about, he's in a high tax bracket. You get taxed higher the more money you make. We know rich people get taxed a lot. People who don't make money get taxed less. But let's see how that actually works. And then I've got some examples here, and then we're going to pull you into my tax planning software. So for someone who is single, and you can see married if that's the case, but we'll do single because that's how my examples are. These numbers here are taxable income. So from your taxable income of $0 to almost $12,000, that income just gets taxed at 10%. The next bit up until $48,000 of your earnings are taxed at 12%. You can kind of see how that goes here. Up to $103,000, you're taxed at 22%. 24% gets you to $197,000. So as a single person, in your mind, you can basically make 200 grand of taxable income and it will be taxed at 24% or lower. It works its way up. I'll show you how that works. You really start getting into those high tax brackets, 32, 35, 37, as you're beyond that 200 and into the several $100,000 range. Now I'll take you to how this plays out for people, and then I will show you an example. So this was a screenshot you just saw, but here is how it works out in practice. So what this shows you is if you had just between $0 and $12,000 of taxable income, you would just be taxed on 10% of that taxable income. But this is really helpful, and you can save this for reference because if you earn above that, you can kind of understand how much tax you owe. So for example, if your taxable income falls somewhere between $48,000 and $103,000, you would get taxed on the $55.78, which is all the tax from these top two brackets, and then just the amount over $48,000 would get taxed at 22%. So let's show an example here. So this example is of a guy named Joe. So Joe, he's a single guy, so he, these apply to him. He earns $80,000 of W-2 income. So that's a standard if you have a salary at a job, let's say $80,000. Now this $80,000 is not what is taxed. So you wouldn't run $80,000 through this scenario and say, okay, you're here, let's do the $5,500 plus 22% of every dollar over. No, because what's taxed is your taxable income. We get tax deductions. So these are a breakdown of tax deductions. So we start at $80,000, that's your gross earnings. Now, if Joe contributes $4,000 to a 401k at work, that is a tax deduction. So he gets, a tax write-off. That what a tax deduction is it's something that lowers your taxable income. Because as we look at these are talking about taxable income. They're not saying what are we taxing Joe's W-2 income. We're saying what do we charge as taxable income. So the difference between what you earn and your taxable income is deductions. 401k contribution, that's $4,000 of deductions. Every single person in the country, if they're a resident, a citizen, get the standard deduction. This actually got bumped to $15,750 after the new tax bill, but I have $15,000 in here because it matches my tax software that hasn't updated. So if you add in $4,000 and $15,000, that's $19,000 of deductions. So the taxable income is Joe's W-2 income of $80,000 minus his deductions. Again, if you're just a normal person, you get a $15,000 standard deduction if you're single. So that means if you earned only $15,000 or less in a year, you would not get taxed at all because you would have, $15,000 here and then $15,000 would be here. Your total taxable income would be $0. Okay, so now we know that Joe has $61,000 of taxable income. That is what gets ran through the tax brackets to get taxed. So let's see how this works. So again, this whole table is for single people, and we're just running through the tax brackets manually so you can understand how it works. So the first tax bracket is 10%, and that tax bracket is for $11,925. So that means your first $11,925 will get taxed at 10%. So we put $11,925 here, and we just multiply it by 10%. So it's just under $1,200 of income. Next, we know that his next $36,000 would get taxed at the 12% tax bracket. And how do we know that? It's kind of tricky, but if you look at this, you can see that the income from $11,926, which is the dollar after the 10% bracket, all the way up to $48,475 gets taxed at 12%. So I just, I did $48,475, which is the cap, minus the $11,925, which is referenced here. Okay, so now we know there's a big chunk of money that gets taxed at 12%. Wish it was 10%, that would be less, but it's 12. Okay, so we multiply 12 times $36,550. That gets you $4,386 of federal tax. So just in these first two brackets, you've earned $48,475, just like we see, and we already owe $5,579 in taxes. And you will notice that is the shortcut that they do for you here. So they're saying if you're in the 22% bracket, just take this $5,579, because we know you already hit it, and add 22% of the amount over that. So that's what we are going to do here. Yeah, I've built calculators that do this all dynamically, but just for the sake of the example, I'm showing you taxable income minus what was already taxed at the 10% bracket minus what was already taxed at the 12% bracket leaves you $12,525 left to tax, and that is in the 22% tax bracket. So that's how you get $2,756. When you add all this up, you see that you have $8,334 of taxable income. So if you were sitting at home and you wanted to do this, you could just follow what this says. You know that your taxable income lands between this and this. You could just take 5578.5, and then it says plus 22% of the amount over 75. So a formula would be something like equals 0.22, because that's how you do 22% times, and then you would do the amount over 4875. So you would do taxable income minus 48,475 with the extra 8, and then you would see that this, is the same as this. So you could, do a shortcut without mapping these all out. So that's how that works. Let's look at tax. Well, before I go to the tax software, let's actually add in a deduction. So let's say you contributed $9,000 more to your 401k. So let's see, before you do this, we're at $8,334 in tax. If you want to contribute more to your 401k, get more of a deduction, you would owe $7,200 in tax. So you would save over $1,000 in taxes if you put in $5,000 more to your 401k deduction. If there was some other random deduction you got, like student loan interest, which doesn't cost you extra money to do, it's just you're paying off your student loans, that would reduce it by $500. So as you see, deductions are good now because they lower your taxable income. Now, what people don't get is deductions, write-offs, whatever. It's not like dollar for dollar. So if you got a $1,000 deduction, this is not going to lower your taxes by $1,000. It's going to lower it by the deduction times your top tax rate. So $1,000 is not going to make this $6,234. It's not even going to make it less than $7,000, because the value of a deduction is the deduction times the top tax bracket you are in. So that's how that works. Let's look at some tax software. I have this, and it basically does exactly what I just showed you, but you don't get to see the calculations. I wanted you to understand the calculations. So in this case, I did the exact same thing. I did $80,000 of a salary minus the $4,000 in 401k, so it shows 76 for wages here. And you'll see that it does do the exact same numbers if I put back what I originally had here. So 8,334. Now, we're going to do a couple things in here for fun. First of all, remember that there is state income tax as well too. Usually the tax rates are lower, but I have this modeled out if this guy was in Georgia. Now, for fun, let's see, a high earner. If you care about taxes, you may be a high earner or somewhere in between. So let's put in a $400,000 salary here and just see how much tax that is. Granted, if you're not a business owner, you're going to have some of this deducted from your paycheck to pay for it. But if you make $400,000 as a single person, you're paying over $100,000 in taxes. So as I'm making this as part of a series on the short-term rental strategy and how you can get massive deductions in the year that you acquire a short-term rental. So there's not like many other ways to do this, but just for sake of example and to illustrate that, I will show you what would happen if we had a, let's say, $150,000 deduction that was received by buying a short-term rental property. So we will add this in here, go to income and expenses, and I'll explain how this works in future videos, but for now we will just plug in a $150,000 business loss here just for the sake of time. And you can see if we lost $150,000 in the business, which would be a $150,000 deduction against active income if you did it properly. There's no guarantees here, make sure you do it right, and I'll explain how to do that. But you can see what it does to the tax bill. If you can create that deduction, you can get your taxes down, from like $103,000 to $54,000 federally. And just again, we'll pop that out so that we can see back to what it was if you didn't do this. No business loss. We're back to $106,000 in federal tax and $20,000 in state tax due. So in the end, you see how taxation works now. It is a bracketed approach. A tax deduction is not free money where you just get whatever you put into it out. It's multiplied the value of the tax deduction by your top tax bracket, and you can also include the state rate in there. But this should serve as a primer so that you understand how taxes work, how the bracket system works to your advantage, and how when you make more money, some people think they keep less, but that's not the case. It's just your new dollars are taxed at a higher rate, not your existing ones. All right, so if you have any questions, drop it in the chat. Again, this is the first video in a series of the short-term rental tax strategy, but I do think that this video is super useful for anyone who makes money and pays taxes. Thanks so much for watching. Hope you have a great day.